Thank you everyone for being back, and it's me again, but this time I will moderate this fireside chat with Professor Gabriel Zucman, and we will reflect a bit on the discussions of the day and in the EU's roles in this new geopolitical space when it comes to taxation and policy. So one note is that we know it's quite late and energies are quite low, so the idea is to keep this interactive. So I will open the floor and ask a couple of questions, but then I want to actually open the floor to you. And so if you have any questions that you've been meaning to ask, please feel free to do so. So yeah, Gabriel, starting with you. So we've been hearing a lot today on many different topics when it comes to EU taxation, EU tax policies, and the future of it and what priorities are. We've been hearing about multinational taxation, Pillar 2 international reforms. We've been hearing about wealth taxation, progressivity. We've been hearing about tax enforcement and digitalization and environment. So a very big mix of things. So maybe could you tell me what were highlights for you, what were key elements of these discussions, and what do you see as key priorities moving forward, basically?
Absolutely, and thanks so much for being here. I think my main takeaway from the first half of the morning is that we need to save the soldier Pillar 2. Pillar 2 is under threat. It's under threat because apparently the current US administration doesn't like it. And what I want people to understand, I think what is really important to understand is that there is nothing to negotiate. So I thought a lot of the discussion that this morning, I didn't really understand why is there a negotiation? Why are we negotiating? Why is the European Union starting a negotiation with the current US administration? That is hard to understand. There was an agreement in 2021 on creating a minimum tax of 15% for multinational firms. The agreement was designed such that there is no need for unanimity. It doesn't matter if a country, the US, China, other countries, don't join it. It was designed in such a way that whatever is the set of countries that implement the minimum tax, they will have the right to overtax the multinationals of countries that would not join the agreement. It was the key idea, the crown jewel in this agreement was this very idea that we are going to have provisions to incentivize participation, because not joining the agreement means leaving money on the table for other countries to grab, and so it's irrational not to join the Pillar 2 coalition. And the idea was that, okay, if some countries don't tax their multinationals, it's not going to be a problem. There will still be a level playing field because the Pillar 2 countries will collect the missing taxes. Okay, so we agreed on that in 2021, and nothing has changed. The US has not passed Pillar 2, even when Joe Biden was in the White House and there was a democratic majority in both chambers of Congress. They were not able to enact Pillar 2 in the US. Trump arrives and says, I'm withdrawing from Pillar 2. No, you're not withdrawing from anything. The US has never been a part of it. So nothing has changed. And there is no reason for other countries to change course. Now, of course, you might say, no, things are different because the current US administration then is threatening the countries that would implement the agreement from various things. And okay, sure, that's been what the Trump administration has been doing in different areas of international economic relation, not only tax, but trade, of course, and other areas. And I think they're learning, and everybody's learning, that there is a limit to what you can do. Just a couple of days ago, the US and China reached an agreement on curbing most of the tariffs that had been announced just a few weeks before, and it's been the story of the last couple of months. Threats, and then backtracking. And backtracking, why? Because those policies of high tariffs, of retaliation, of coercion, are lose-lose. They are not in the interest, obviously, of the European Union, China, the countries that are on the receiving end of those threats, but they're also not in the interest of the United States, or at least of most people in the US. So this type of approach has a clear limit, and so, let the current US administration, do whatever threats it wants to do, but, there's just no reason to cave in. And caving in is being more Trumpist than Trump himself. Is doing his will for no good reason. So what I want to say, first of all, is there was this agreement. Look, it was not a revolution. 15% minimum tax on multinational firms. In practice, less than 15% because of different exemptions and carve-outs. But just saying, look, the rate should be slightly higher than 0, which seems a bit too low. Perhaps something between 10 and 15. That's not some radical idea. And that needs to be preserved. Okay, there's really no compelling reason from backtracking. I think we are really at a turning point, because even though the 15% minimum tax is not very ambitious, it is conceptually a potential turning point in the regulation of globalization. It's the first time ever that there was an agreement on a common minimum tax rate. And more important than that, it was the first agreement that included this idea of extraterritorial taxation, because yes, the UTPR is a form of extraterritorial taxation, but it's a good, positive form of extraterritoriality. It's a form of extraterritoriality that says, look, free trade cannot come without minimal tax obligations. And if your multinationals want to keep having access to our markets, they have to face some minimum. Again, 0% is too low. They have to face at least 15%. And if they don't pay 15% in your country, we will collect the difference. And that idea is hugely important because it can really change the face of globalization. It can replace the race to the bottom that we've experienced since the 1980s with a race to the top. Why? Because we all understand, that such mechanisms provide incentives for countries to implement their own minimum taxes, and that's how, in principle, and that's already happening, a number of low-tax countries, instead of choosing 0%, are incentivized to choose tax rates of 15%. And if the rate increased to 20, 25%, we could see those countries very quickly increasing their own tax rates. Okay, so it can replace the race to the bottom by a race to the top, and in some sense invert the forces of tax competition that have been so harmful for our economies. Okay, so we are at a turning point because either we defend and fight for those ideas and those principles that are still burgeoning. So I think many people have not, it's difficult to understand how big this could become down the road because Pillar 2 is so modest in its ambitions, and yet there is an embryo in that approach of a pretty radical change in international economic relation. And so that's why, from my perspective, it's really very important to defend Pillar 2. We've been critical at the EU Tax Observatory of the global minimum tax of 15%. In the Global Tax Evasion report that we released at the end of 2023, we said, look, 15% is way too low. there are exemptions, carve-outs, and so on. We also flagged, that was 2 years ago, almost 2 years ago, we said, look, there's going to be a problem because there is a safe harbor for US multinational companies that was introduced in 2022 or 23, and we flagged that very forcefully in the report, saying that is really dangerous. It's opening the door to an unraveling of the global minimum tax, because once you start exempting US multinationals, even if it's for just 2 years, it was supposed to be a temporary safe harbor until 2026. Once you open that door, it's going to be very hard to close it. And I think we had very accurately predicted exactly what's happening. We opened that door, and now the feeling I got from this morning and other conversations in Brussels is that we're moving. There is a high risk, at least, that we're moving towards some form of permanent exemption for US multinationals. If US multinationals are not subject to the 15% minimum tax, we are back to square one. We are back to the race to the bottom. There will be incentives for firms to relocate to the US. We are back to the logic of tax competition, and everything that's been done, or not everything, but all the energy that's been spent since 2015 at least in changing these harmful dynamics will be for almost nothing. But it's not too late, right? So the commissioner was somewhat uplifting, I think, in his remarks, saying, no, look, it's still open. It's good to have a dialogue. And so there is still hope. But I think it's really important to make the case forcefully that Pillar 2 needs to be saved, the UTPR in particular needs to be saved, and there is just nothing to negotiate because nothing has changed. Okay, so that was number one. Number two was the billionaires, or more accurately, ultra-high net worth individuals. And it's important. It's actually an important distinction because there are, in many countries, relatively few billionaires, but in all countries, including in almost all developing countries, you always have a significant number of individuals who have more than 100 million euros in wealth or tens of millions in wealth. And everywhere there is the same problem, which is that those individuals, for them, the income tax just doesn't work very well. And it's not a new thing. The income tax was created about a century ago in many countries. It was one of the most important developments in fiscal history of world history. But 1 century after this revolution, I think what we've learned over the last few years is that this revolution remains incomplete, in the sense that the income tax almost always fails to tax the super rich. For the super rich, the income tax is no more in practice than a mere consumption tax. Because when you're extremely wealthy, you can easily, most of your income corresponds to profits in companies that you own. That's what it means to live in a capitalist society. In capitalist societies, wealth and power derives from the ownership of corporations. The wealthiest people are people whose wealth mostly derives from the ownership of companies, and almost all their income derives from that. And when your income derives from the ownership of companies, it's very easy to avoid the individual income tax by using holding companies or trusts or holding structures, similar holding structures in other contexts. And so we have this problem everywhere. And I think what was great to see today is the progress that's been achieved in just a couple of years, I think, in describing the issue and moving to not only a common understanding of the problem, but also a common understanding of the solution to that problem. And the solution is very simple, since the income tax doesn't work, you need to supplement the income tax. You need a top-up to the income tax. You need a minimum tax for the super rich. And to be effective, this minimum tax has to be expressed not as a fraction of income, because that's the whole problem. The notion of income is not well defined for the super rich. The minimum tax has to be expressed as a fraction of wealth. Okay? And our feeling is that those ideas are now well accepted, and we see the debate ramping up in many member states, in a number of countries, many countries outside of the European Union. We see the progress that was achieved at the G20 last year, but now the conversation moving to other forums like COP, like Finance for Development. And it makes me quite optimistic to see how in just a couple of years we've made all that progress that in just a few years in the future we could see this becoming in some form a reality. So I think that was really exciting. And when it comes to tax evasion, I want to emphasize, perhaps again, I briefly alluded to this morning, and many of the panelists mentioned that, but the importance of the automatic exchange of bank information. Not because it has solved the problem of offshore tax evasion, there is still a lot of it going on, and there are many other forms of tax evasion, but just to, as a concrete illustration, that just like we can choose competition, we can choose coordination. And those are perfectly feasible choices, and this view that international tax competition is some kind of law of nature, is inherent to modern open economies, is just completely wrong. Okay, that's really important because this is a really widespread view where people feel genuinely like, okay, there is a demand for more social and economic and climate justice in all countries, but we are just powerless because if we do anything, there's going to be capital flight, there's going to be tax evasion, and so there's just nothing that can be done. And the clearest illustration so far that this view is wrong is the Common Reporting Standard. Because I remember very well that when I started working on these topics 15 years ago, the very notion that there could be an international agreement on automatic exchange of bank information was deemed as totally crazy. Nobody, if we had had this conference in 2007, nobody would take that idea seriously. Almost nobody. I mean, some NGOs were talking about that and taking it seriously, but among policymakers, among economists, that was deemed as, totally stupid because the view was, look, if a country like Switzerland wants to have strict bank secrecy laws, that's their choice. What can you do? It's just a given, and there's nothing you can do to change that. And now we are in a radically different world, at least when it comes to the law itself. Then there are questions of enforcement, of implementation, and we could do much better. But I think this illustrates this very important idea that relatively quickly, the forces of cooperation can prevail over the forces of competition. And that's what makes me optimistic for the future.
Great. Thank you very much. I think this was an amazing overview and quite optimistic, I gotta say, so that's very encouraging. I think now we have approximately exactly 10 minutes, so I actually would like to open the floor already for the questions from the public. So if someone has any questions, I see one there. Great.
Yes. Hello, I'm Malte from the German Chambers Organization. When the level playing field between us and the US is more important than the technical details, what would happen if we adopted here the guilty and the jurisdictional blending? What would be the consequences for our tax revenue? Thank you.
Okay, great question. So let me address that. I know that many people like to say that the intellectual father of Pillar 2 is Donald Trump, but this is not true. This is not true. And he doesn't deserve any credit for Pillar 2. And I think this is well exemplified by the fact that guilty is fundamentally different than Pillar 2. And this was well understood at the time, and in particular when the Tax Cuts and Jobs Act was under discussion in the US and guilty was introduced. The fundamental difference is this. Guilty is a minimum tax, indeed, of 15%, indeed. So you might say, well, that's very similar, or 12.5%, that's very similar to Pillar 2, superficially, except that it's a minimum tax on all foreign income of US multinational companies. So you take their total foreign income, you take the total taxes that they pay, adding up taxes that they pay in high tax countries and low tax countries, and if the rate is below 12.5%, and they have to pay some extra tax according to guilty. Okay, so that's guilty. Pillar 2 is a minimum tax on a country-by-country basis, meaning if you pay 40% in some country and 0% in Bermuda, with guilty, you have no extra tax to pay. Okay, the 40% offsets the 0% paid in Bermuda. With Pillar 2, the company has more tax to pay. You know, for the country, let's say Japan, where it pays 40%, nothing changes. But in Bermuda, it has to pay 15 points extra to arrive at 15% on a country-by-country basis. You might say, well, it's a technical detail, you know, who cares about that? It changes everything. It changes everything because this is what gives incentives to tax havens to increase their tax rates. That's what provides an incentive to a country like Bermuda to say, okay, no, we are going to increase our tax rate to 15% to collect some of that tax ourselves, because if we don't do it, we know that the other countries are going to collect it on our behalf. This incentive is not present in guilty. Guilty has no potential to start a race to the top. It does nothing to create a dynamics like that. In contrast to Pillar 2, with the UTPR in particular, which is supposed to unleash this positive race to the top. It is conceptually, fundamentally very different. And then there's, of course, the consequence of that, which is the basic tax revenue implication, which is that guilty doesn't generate a lot of money, a lot of revenue. A country-by-country minimum tax has a much higher order, at least an order of magnitude higher revenue potential than a guilty type mechanism. And so saying we're going to kind of treat guilty as kind of equivalent to Pillar 2 is just not acceptable, is a total conceptual mistake with first order revenue implications.
Great. I think there was one question there.
Yeah. Chiara Putatura from the Oxfam European Office. Thanks, first of all, for organizing this very interesting event. My question is about measures on taxation of high net worth individual, what the European Union could do. This morning in the wealth taxation panel, we heard that the European Union is always waiting for someone else to do something. And also the professor of the London School of Economics said that the EU could start by making the exit taxes easier to apply by member states. And my question is, what do you think the European Union could start doing before arriving maybe to a minimum taxation of the wealthiest? Thanks.
That's a good question. You know, it's indeed the question of what are the intermediate steps before we reach that agreement, and there are different steps that can be taken. One obvious first step is to improve transparency about who owns what, and in particular the wealth of ultra-high net worth individuals. This is one of those areas of economic statistics where public economic statistics are wholly deficient. There's no official data on what's the income, the wealth, the taxes paid by ultra-high net worth individuals. And first step should be to collect that information. And that information is really not difficult to obtain once you understand that the key source of their wealth and hence of their income is their ownership of companies. And we're not talking about barber shop, shoemaking companies, or your regular mom and pop business. We're talking about multinational companies. And there's already reporting on a country-by-country basis of the profits and sales and so on of multinational companies, CBCR, and those reports are already exchanged internationally. So the main thing that very practically, that we could do and that we should do in the short term is to extend the CBCR by including information on beneficial owners. That is, the multinational firms should be required to list on those CBCR all the individuals who directly or indirectly own more than, let's say, 1% of the stock of the company. And then include that information in the CBCR that you share with other tax authorities. Immediately, this would allow countries to capture perhaps 90% of the wealth of their domestic super rich individuals. And then you have other stuff. Sure, you have the yachts and the Picassos and these things. Sometimes people believe that it's like a huge fraction of the wealth of billionaires, but no, it's a relatively small fraction. So building on what exists, extend it, and already we create a lot of transparency about the wealth of the super rich. That would be the first step that we can and should agree on in the short term.
Amazing. I think we have another question. Yeah.
Yeah, thank you very much. My name is Miroslav Pansky. I'm Charles University in Prague and Tax Justice Network. I have a question about the unitary tax and kind of what's your view on the role of the EU? What should they do? There was a great keynote address by Tovi about this, and I was wondering what your views were.
I'm a great fan of unitary taxation and equivalently of getting rid of the system of transfer pricing, which is outdated. It was created a century ago. Many of you might be familiar with the history of this. It was created in the 1920s when there was the beginning of the rise of modern multinational companies, and so the League of Nations at the time was concerned about risks of double taxation, and so commissioned 4 economists in the 1920s to write a report about how to best address this risk of double taxation. And they produced this report. They said, look, okay, subsidiaries of a given multinational should be trading between themselves as if they were independent entities using transfer prices, arm's length pricing, and so on. And we all understand that this system is not working. We know it's not working because in the countries where you have sub-national corporate taxes, like in the US, you have state-level corporate taxes. In Germany, you have municipal-level corporate taxes. In Canada, you have provincial-level corporate taxes. Everywhere where you have subnational corporate taxes, no country uses transfer pricing. That just, everybody understands that it would never work, and they all use formulas to allocate profits to the different local governments. That's the way to go. We have to do it. And number two, once we understand that there is a need for a truly inclusive international negotiation about how the formulas should be, how the profits should be allocated, an international discussion that has to take very seriously the interest of Global South countries, and that has to approach those issues from the perspective of Global South countries, I would say. Precisely the opposite of what was done with Pillar 1 and with the inclusive process, which was very inclusive for tax havens and much less inclusive for big emerging economies.
Great. I think we have only 1 minute left, so I don't know if there is any more questions on the floor, but no. Okay, great. Thank you very much, Gabriel. If I could ask you one last question, would be what would you want to see next year when we come back here and do next year's edition?
Oh, I think you know the answer. I want to see a minimum tax on ultra-high net worth individuals in as many countries as possible. What I want to say is that there's absolutely no need to wait for an international agreement. There's no need to wait for unanimity at the EU level. I mean, we might wait for several decades. Everything can be done by countries acting unilaterally. And if it ever happens, this international coordinated minimum tax on the super rich, it will be because some countries do it first, and it creates a process where others, imitate, and that's always how change happened. That's how the progressive income tax was adopted gradually by almost all countries a century ago. So I'd like to see some progress on that.
Amazing. Thank you very much, Gabriel. Thank you very much.